where we are this morning talking energy. World leaders getting ready to impose a price cap on Russian energy. Discussions well underway. But what will it actually mean for supply and the price the world pays? Very pleased to be joined by Justin Dargin, global energy expert at Carnegie Endowments. Justin, good morning. Thanks for joining us.
Good morning. Thanks for having me.
Right, so G7 leaders and the European Union trying to agree on a price cap for Russian energy. Where are we now in negotiations?
Well, one of the principal issues is that there has been a lack of consensus because there is a dispute about where exactly the price cap should be. So, for instance, you have some countries which are more, let's say, anti-Russian to a certain degree and want to penalize Russia much more, such as Poland, Lithuania, and Estonia. And they feel that the price cap that should be deployed should be around $30 or so. The current discussion is around $65 to $70. That's where currently we're at. But Poland and Lithuania, Estonia, they want to go much lower because the reason for that is they say that you really have to cut Russia to the bone in terms of its financial reserves. And the technical cost of production for Russian oil is roughly about $20, although some fields can go as high as $75 per barrel. So you have that. And then you also have another faction, which is more or less promoted by I would say Malta, Cyprus, and Greece, which, of course, have the majority of the shipping companies in the EU. And they think that that price level is actually much too low. And they actually think that it should be a bit higher. And they feel that they are going to lose a significant amount of business. So they want to be compensated if some price cap is deployed and they won't be able to obtain the regular business. So this is where we're at the moment. But we do expect that potentially there should be some type of consensus coming within the next few days or so, perhaps even tomorrow.
What does a price cap of $65 to $70 actually mean for Russia? I mean, taking politics out of it, but the reason that a price cap has been proposed is to try and cut the amount of money that Russia can make from its energy. And if, as you say, that is multiples of what it actually costs Russia to get energy out of the ground, would it have any effect?
Yeah, well, there are actually two issues that need to be considered. One is the break-even price, the technical break-even price, which is the cost or the price of a barrel of oil that Russia needs to acquire in order to continue producing from a particular reservoir. So that's one break-even price. Then you have another break-even price, which is the fiscal break-even price. And that is the price of a barrel of oil that Russia needs to acquire in order to maintain budgetary solvency. So to continue to operate its economy and to pay its debts and so on and so forth. So if you have a price cap from between $65 to $70, let's say, Russia is already selling its oil at a heavy discount. So about $67 or so, give or take. So really, at the moment, if you have a price cap at that level, it's not going to have a significant impact upon Russia. And at the same time, though, this price cap was developed or proposed in order to, how can I say, to create a type of safety valve. Because the European import ban is going to come into effect December 5th. And the European Union was afraid that with the implementation of the ban, that there's going to be a relatively high price spike. And this is something, of course, that the world doesn't need, Europe doesn't need with the high inflationary pressure and also the slowdown in the global economy. So when you institute a price cap, this actually creates a type of safety valve because Europe still wants the oil to go to the international market without creating a price spike while reducing the amount of revenue that Russia would be able to acquire.
Okay, so in theory, what would a price cap of around $65 mean for the global energy picture?
Well, I mean, what's happening right now is that potentially Russia is able to still ship in the, let's say, in light of any type of price cap, to still ship or to skirt, let's say, European price caps or the G7 price cap potentially by about 70 to 80%, because you do have a significant global shadow fleet that has been established over the past several decades or so that have helped certain countries evade maritime shipping bans, such as Venezuela and so on. So it is completely possible that Russia would be able to continue to ship its oil. But we do see a lot of trade already migrating to the east. So we see, of course, India, acquired a lot of Russian crude, and then we also see China, of course. I mean, so that's one of the major issues that we're seeing. So fundamentally, in terms for the Russian economy at the moment, if you have a price cap that is set at the level of the price that it is currently selling its crude for at discount, it's not going to have a major impact. But at the same time, when you have this European ban coming into effect, Russia really has to make certain that to wherever it ships its oil, these countries will be able to absorb it. And it doesn't look like China at the moment is offering any type of relief from its extremely strict COVID policies. And even it had the highest number of COVID infections, I think, during the entire pandemic. And it happened quite recently. So it seems like Chinese demand would still be relatively low.
I was looking at the Moscow Times this morning. There's warnings of consequences for a price cap. What could that look like? Will we actually see Russia halting supply?
Well, actually, Russia has threatened to, let's say, retaliate against any countries that adhere to the price cap. But it doesn't look like any countries outside of the G7, outside of the European Union and the West, of course, would adhere to it. But actually, they don't really have to adhere to any price cap, given the fact that they are able to negotiate much lower prices. And that's more or less what the European Union desires in the G7, is they actually want to empower many of Russia's traditional buyers to negotiate lower prices, even if they don't necessarily adhere to the price cap. But Russia has threatened, of course, to shut off gas exports. So we have seen reductions, of course, in gas, which is transported through Nord Stream 1. And then also there have been reductions in gas shipments through Ukraine at the same time. I mean, so potentially Russia could pull the trigger and let's say, implement a full gas shutoff. Of course, it wouldn't do itself any favors economically, but if it seeks retaliation, then it could potentially do that.
Right. Well, let's look at the demand side of the equation. You've mentioned China's rising COVID numbers there. I was also looking at the gasoline builds in the US, suggesting people might be driving less over Thanksgiving. What does the demand picture look like?
Well, I mean, you're absolutely right, Brady. So we do have a quite surprising increase in the U.S. Stockpile, gasoline stockpile. So I believe it increased by about 3.1 million barrels or so. So that's something which was a bit unexpected. And of course, you have somewhat of the global recessionary pressure, which is building. And of course, as you indicated, China. At the same time, though, we really have to see what's going to happen come December 5th. I mean, so that's really going to be the major, let's say, date of where the confusion that is ongoing in the international oil market is going to sort itself out. And actually, I would say February 5th is when the EU oil products ban comes into effect. And I think that potentially could even have more of a negative economic impact upon the EU in the sense of European imports of diesel, which still a large percentage of the European transport sector runs on diesel, and also the agricultural sector and so on and so forth. I mean, so we might see extremely difficult economic situation developing from the embargo, which is going to be implemented on February 5th as well.
Thanks so much for joining us this morning live from Washington. Justin Dargin, global energy expert with the Carnegie Endowment Fund.